Welcome to the session on partnership accounts. If you look at your CPT syllabus, this chapter has been divided into broadly four topics. One is the fundamentals of partnership, second is admission of a partner, third is retirement of a partner, and fourth is death of a partner. We are going to be looking at the first two topics today, which is fundamentals of partnership accounts and admission of a partner. Before we get started with the answers to the questions that you've taken for the test, I'll tell you something in brief about uh, what partnership accounts is and what you need to keep in mind when you answer questions from this chapter. Right? See, partnership is basically a relationship between two or more persons who have agreed to carry on a business and to share profits of a business that is carried on by all or any one of them acting for all. Okay. And all partnership firms are governed by the Indian Partnership Act of 1932. So it is the Act which has given us this definition. Section 4 of the Act has defined partnership like this, basically as a relationship between two or more persons. Right? So persons means any person who is competent to contract under the Indian Contract Act. So obviously a person who is insolvent, a person who is of unsound mind, and a person who is a minor cannot start a partnership firm. However, a minor can be admitted into a partnership firm later by the mutual consent of all partners. So the fundamental characteristics of a partnership firm are: a partnership is something that is brought into existence by two or more persons. So it is not necessary that they have to be people, right? A company can enter into a partnership with other entities. However, two partnership firms cannot form a partnership firm because the partnership firm is not a legal entity. It is only the partners that constitute the firm. Okay, it is only the partners who can suppose there are two firms. Let us say Messrs A and B is one firm and Messrs X and Y is another firm. Messrs A and B and Messrs X and Y cannot form a partnership firm because Messrs A and B and Messrs X and Y are not separate legal entities. However, the partners of A and B and the partners of Messrs X and Y can form a partnership firm, right? So then we said there should be an agreement. So is it necessary to have a written agreement? No. Even an oral agreement is fine. However, it is encouraged to have a written agreement because it's always better to fall back on something that is written in case of disputes. Right? So it is not necessary that there has to be a written agreement. An oral agreement is fine. And next is sharing profits of a business. So they decide to share profits of a business that is carried on by all or any one of them acting for all. This is the most important feature of a partnership firm, which is the principle of mutual agency. See, suppose there's a partnership firm which has three partners A, B and C, and if A enters into a contract with a third party on behalf of the firm, then A is the agent for B and C, and B and C are the principals of A. Right? Likewise, if B is entering into a contract on behalf of the firm, then B becomes the agent and A and C become the principals. And what is the relation? What is the implication of this? It means that all of them are responsible for the acts of a partner. That is, they are all jointly and severally liable for the acts of a partner. Right? That is the essence of a partnership agreement or a partnership arrangement. Right? Then the next most important thing is, what is a partnership deed? Okay, a partnership deed is nothing but a written agreement. As I told you, it is not necessary to have a written agreement, but generally all firms have a written agreement which is called a partnership deed. Now, what does this deed contain? This deed basically gives us the name of the firm, the names of the partners who constitute the firm. What is the profit sharing ratio? Are the partners entitled to salary? Are the partners entitled to commission? Are the partners entitled to interest on the capitals that they have contributed? Are the partners entitled to drawings? Entitled to, or rather, are the partners chargeable interest on the drawings that they make? Okay, so And how is goodwill to be valued in the event of admission of a partner or event of retirement or death of a partner, right? So all these, how is a retiring partner to be settled? Okay, so all these are the various items or various um, particulars which are contained in a partnership deed. When the partnership or the deed or the agreement, when it is registered under the Partnership Act of 1932, it becomes a partnership deed, right? So an agreement, if it is not registered, it remains an agreement, right? But if an agreement is registered with the Indian Partnership Act of 1932, it becomes a partnership deed. Now what happens if there is no partnership agreement? The firm cannot file a suit against a third party. However, a third party can still file a suit against the firm. Even if there is no registered partnership deed, a third party can file a suit against the firm, against the partners of the firm, but the firm or its partners cannot file a suit against a third party. Okay, that is the implication of not having registered the partnership deed, right? Then, suppose there is no partnership agreement or there is no partnership deed, then there are certain areas where the provisions of the Indian Partnership Act shall directly apply. Okay, so I repeat, if there is no partnership agreement, then there are certain areas where the Indian Partnership Act, the provisions of the Indian Partnership Act shall apply. Now, what are those areas? First is interest on capital. No interest on capital shall be allowed if there is no partnership agreement, or where there is a partnership agreement but if the partnership agreement is silent, then no interest on capital shall be allowed on the capital balances of the partners. Secondly, interest on drawings shall not be charged. Okay, suppose there is no partnership agreement, or where there is a partnership agreement but the agreement is silent, then no interest on drawings shall be charged. Thirdly, the partners are not entitled to get any salary or commission. Fourth, the profit sharing ratio shall be equal. Fifth, in case a partner has advanced a loan to the firm, then he is entitled to get interest at the rate of 6% per annum on the balance of the loan. Okay, so these are the various areas, these are the 5 areas where the provisions of the Indian Partnership Act shall apply, where there is no agreement or where there is an agreement but it is silent with respect to these matters, right? Now, having understood this, you must understand the accounting for partnership firms. Uh, as usual, a trading and profit and loss account is prepared. The trading account will give the gross profit. The profit and loss account will give us the net profit. And then, before the balance sheet is prepared, a special account called the P&L appropriation account is prepared. Okay, so P&L appropriation account is an account which is prepared for partnership firms. And what does this P&L appropriation account mean? Basically, it shows us how the profit that is earned by the firm is appropriated to the various partners. It could be in the form of interest on capital, it could be in the form of interest on drawings, it could be in the form of salary or commission to the partners, and finally whatever is left is distributed to the partners in their agreed profit sharing ratio. Or if there is no agreement, it is distributed to them equally, right? So this is the P&L appropriation account. After this, we proceed to prepare the capital accounts of the partners. Now here again there are 2 methods of preparing capital accounts. One is the fluctuating capital method, the other is the fixed capital method. Now what is this fluctuating capital method? Fluctuating capital method, only one account is opened, that is the capital account. All transactions relating to the partners' capitals will be routed through this account. So we will start with the opening balance of the partners' capital accounts. Usually it is a credit balance, but in case there are overdrawn balances or where the firm is making losses continuously, it is possible that the partner's capital accounts have a debit balance. So in the normal case, capital accounts will have credit balances. So you start with the credit balance, then the further addition of capital, drawings of capital, then the interest on capital, interest on drawings, share of profit of the firm, all this is routed through this capital account, right? So the closing balance can either be a debit balance or a credit balance, right? Next, the other method is the fixed capital method, where two accounts are opened. One is called the capital account, the other is called the current account, right? So capital account records only the opening balances and the withdrawal or additional infusion of capital, right? All other transactions relating to partners' capital accounts are routed through a separate account called the current accounts. That is drawings, that is a monthly drawings, interest on capital, share of profit or loss, all this will be routed through the current accounts. So while the capital accounts will always have credit balances, current accounts can have a credit balance or a debit balance, right? So this is, then after this we as usual proceed to prepare the balance sheet of the firm. So this is in brief with respect to the accounting for partnership firms, right? So with this background, we will look at the questions. Okay, let's go to the first question. Partnership is the relationship between two or more persons who are sharing the profits and losses equally of a business carried on by all or any one of them acting for all, who have agreed to share the profits of a business carried on by all, who have agreed to share the profits of a business carried on by any one of them acting for all, none of the above. So the answer to this is none of the above, because options A, B and C do not define partnership. Partnership is a relation between two or more persons who have agreed to share the profits of a business carried on by all or any one of them acting for all. So unless all these are present, it is not a partnership, right? So answer is D, none of the above. Next, business of the firm must be carried on by. So we know the definition. It says business has to be carried on by all or any one of them acting for all. So option A is not right. Majority of the partners only is not right. All the partners, it's not necessary. It can be carried on by all or any one of them acting for all, because there can be firms where there are sleeping partners. Sleeping partners means they are not actively involved in the day-to-day activities or the operational activities of the firm. They would have just contributed capital. Okay, so they are sleeping partners. That doesn't mean the relationship is not a partnership. It's, as I told you, a partnership is a mutual agency. So it can be carried on by all or any one of them acting for all. So answer is D, none of the above. Next, the essential elements of a partnership must coexist before a partnership can come into existence, may be brought in within a reasonable time of a partnership coming into existence, may be brought in at any time either during the creation of a partnership or even thereafter before a partnership comes into existence, but they must coexist within 1 year of a partnership coming into existence, none of the above. So the essential elements have to exist before it can come into existence. Okay, so it is not allowed to bring all the necessary elements after the partnership has been formed. In order to form a partnership, the essential elements have to exist before it can come into existence. So answer is A. The essential elements of a partnership include: there must be an association of 3 or more persons. No, it's enough if there are 2 persons. There must be an agreement to share profits and losses equally. No, in fact, there need not be an agreement to share losses at all. It is an agreement to share profits in some ratio. Okay, and it need not be equally. There must be mutual agency among partners. Yes, it is the essential element. The relationship must be registered. It is not necessary. It can just be a written agreement which is not registered, or there need not even be a written agreement. It could be an oral agreement, right? So answer is C. Next. In case of non-registered partnership firm, a partner can file a suit against the firm. No. A partner can file a suit against any partner of the firm. No. The firm can file a suit against third parties. No. Third party can file a suit against the firm. Yes. Okay. So that is the benefit of registering a firm, where all the options you know will hold good. Where a firm is not registered, a third party alone can file a suit against the firm, whereas one partner cannot file a suit against the firm. A partner cannot file a suit against the other partners, and nor can the firm file a suit against third parties. Okay. In the absence of any agreement, interest on advances by a partner is allowed at 6% per annum. Okay, and where the date of the loan, suppose in a problem that you face in your exam, the date of loan is not given, then you can assume that the loan was given at the beginning of the year, and hence you can calculate interest at 6% for 12 months. Okay. Next. Interest on capital subscribed by a partner may be provided for in the partnership deed is, okay, there is no limit on the interest on capital that can be provided. It can be any rate, but the condition is interest on capital can be paid, or it can be credited to the partner's capital accounts only when the firm has made profits. Okay, so in case a firm has made losses, then it cannot pay interest on capital to its partners. But however, whether there is profit or loss, in case of partner has given a loan to the firm has to pay interest. Okay, the interest on the loan that the partner has given to the firm will be credited to the partner's capital account, whether he has made profit or not, because interest on advance that a partner has given to the firm is a charge on the profits. It's not an appropriation of profit, it is a charge on the profit. The interest on that loan does not appear in the P&L appropriation account, it appears in the profit and loss account of the firm, because it is a charge against the profits of the firm. Okay, so here answer is D. Next. Following are the essential elements of a partnership firm except at least two persons. Yes, it is an essential element. There is an agreement between all partners. Yes, all partners have to agree to it. Equal share of profits and losses, not necessary. It can be any share. A, B and C might decide to share in the ratio of 5:3:2, or 4:3:3, or 2:1:1. It could be any ratio. So that is not an essential element of a partnership firm. And partnership agreement is for some business. Yes, it has to be for some business. So it means that you cannot enter into a partnership in order to do charity, because charity there is no profit motive. Business means there has to be a profit motive, and hence it is an essential element of a partnership firm. So answer is C. Next. In the absence of any provision in the partnership deed, interest on loans and advances by a partner is, yeah, it will be allowed at 6% per annum. It will be allowed only out of profits. No, as I earlier told you, interest on loan that a partner has given to the firm is a charge against the profits of the firm, and hence it has to be allowed even if there are no profits. So answer is A and C. Which of the following is provided even if there is no provision in the partnership deed and there are no profits? Okay, so interest on partner's capital cannot be provided if there is no partnership deed, or where there is no provision in the partnership deed. Interest on partners' loans and advances, yes, it has to be provided at 6% per annum, even if there is no provision in the partnership deed, and even if there are no profits. Next, which of the following appear in the P&L appropriation account? Salary or commission to a partner, it appears in the P&L appropriation account. Salary or commission to a manager is a charge against profits, and hence will appear in the P&L account. Interest on capital of a partner is an appropriation of profit, and it will appear in the P&L appropriation account. And so answer is both A and C. Next, when is a profit and loss appropriation account prepared? Okay, it is prepared for a partnership firm. It is not prepared for a sole proprietor, because in case of a sole proprietor there is only one person who is carrying on the business, and whatever profit the business makes belongs to him. So there is no question of appropriating the profit. But in case of a partnership firm, that's not the case, right? Because there could be many partners, and hence the necessity to prepare a P&L appropriation account to show how the profit is getting appropriated to the various partners. Okay, next, 13. X and Y are partners with capitals of 50,000 rupees and 30,000 rupees respectively. Interest is payable on capital at 10% per annum. Find the interest on capital for both the partners when profits earned by the firm is 4,800 rupees. Okay, so here the capitals are 50,000 rupees and 30,000 rupees. Okay, and the interest on capital is 10%, which means one partner is entitled to get interest at the rate of 5,000 rupees. The second partner is entitled to get interest at the rate of 3,000 rupees. So total interest on capital is 8,000 rupees. Okay, but what is the profits? What are the profits of the firm? It is only 4,800 rupees. Okay, so what we have to keep in mind is that with respect to interest on capital, two things we have to keep in mind. One thing is where the firm has made losses. Where the firm had made losses, no interest on capital. Okay. Secondly, where the profit is insufficient. Where the profit is insufficient, the interest on capital will be restricted to the profits made, and this profit will be distributed in the ratio of capital contribution. Okay, so I will repeat, with respect to interest on capital, you have to keep two things in mind. One thing is where the firm has made losses, there is no interest on capital. But in this case, in our problem, the firm has made a profit. But what is the scenario? The profit that the firm has made is much less than the interest on capitals. Then what do we do? So this is a case of insufficient profits where the interest on capital will be restricted to the profits available, and this profit will be distributed to the partners in their capital ratio of 5:3. Which means the first partner will get 5 by 8 of 4,800, which is 3,000 rupees, and the other partner will get 1,800 rupees as interest on capital. Okay, so the answer to this question is B. Next, A, B and C are partners with capitals of 50,000, 40,000 and 30,000 respectively. The firm's reported profit for the year was 79,200. As per provisions of the Indian Partnership Act 1932, find out the share of each partner in the above amount after taking into account that no interest has been provided on an advance by A of 20,000 rupees in addition to his capital contribution. Okay. Right. So here we have three partners, A, B and C, and the profit for the year is 79,200. Okay, and what is the profit sharing ratio? It is not given to us, which means that it is equal. Then what are they saying? They're saying that this profit of 79,200 has been arrived at before taking into account the interest on the loan that A has given to the firm. So we know that since the rate of interest is not given to us, we will take interest at 6% per annum. So interest is 1200 rupees. So this interest is a loss to the firm, right? It's an expense for the firm, and so our revised profit will be 78,000 rupees. Okay, so this 78,000 rupees will go to A, B, and C in the ratio of 1 is to 1 is to 1. So it's 78,000 divided by 3, which is 26,000. 26,000. 26,000. But we must remember that in addition to getting the share of profits of the firm, A will get interest on the loan that he has given to the firm, and so A's share is 27,200, B is 26,000, C is 26,000. Okay, so answer is A. Next. Following are the differences between capital accounts and current account except. Okay, capital account is prepared under fixed capital method, whereas current account is prepared under fluctuating capital method. See, this is not correct in the sense that under the fixed capital method, capital account is prepared and current account is prepared, and under the fluctuating capital method, the capital account is prepared. Okay, so we don't need to go through the other options because it's quite obvious that A is the answer. Okay, next. If a fixed amount is withdrawn on the last day of every month of a calendar year, the interest on total amount of drawings will be calculated for 5.5 months. Okay, this is the see, drawings can happen. It is possible that drawings happen, a fixed amount is drawn on a particular date, month after month, right? So in that case, the interest will be calculated. Suppose the drawings are made on the last day of every month of a calendar year, then the drawings, interest on drawings will be calculated for 5.5 months. Then fixed amount is withdrawn on the last day of every quarter of a calendar year, then it will be calculated for 7.5 months. Then, if a fixed amount is withdrawn on the middle day of every quarter of a calendar year, then the interest on total drawings will be calculated for 6 months. Guarantee given to a partner A by the other partners B and C. Okay, so sometimes what happens is, depending upon the agreement between partners, one partner will be given a minimum share of profit, which means that in case the firm has made a loss, okay, in case the firm has made a loss, or where the it isn't where the firm has made insufficient profits, and the share of profit for for one of the partners, or let's say the guaranteed partner, is less than the minimum profit guaranteed to him, then the shortfall will be borne by the other partners. They are called the guaranteeing partners. So here, a guaranteed partner means a partner to whom a minimum share of profit is guaranteed, and the guaranteeing partners are the other partners who agree to make good the shortfall to the guaranteed partner. Okay, and it will be in their relative profit sharing ratio. So here, answer is guarantee given to a partner A by the other partners B and C means in case of loss or insufficient profits, A will withdraw the minimum guaranteed amount. Next, under super profits method, goodwill is calculated. Okay, so now goodwill calculation is another important aspect with respect to this chapter. Goodwill is basically the value that we try to give to the reputation that a firm enjoys. Okay, and it could be because of the location of the partnership firm, it could be because of the clients that the partnership firm has, and basically because of the service that the partnership firm is able to render to its clients. And The existence of goodwill is again evident by the profits that the firm makes year after year. So there are some methods that are generally followed for valuing goodwill. There are four accepted methods. The first method is the average profits method. So this is a very simple method where we just take the average of last 4 years, 5 years profits. Again, uh, how they want to value goodwill depends upon the decision that the partners take. They might appoint a valuer, and the valuer might say, let us take past 4 years profits. So it is not a rule that is written somewhere in the act. It varies from case to case. They might take only last 3 years profits, 4 years profits, it could be 10 years profits. It depends upon case to case. Okay, so the simplest method is the average profits method, where we just take an average of the number of years, average of the profits of a certain number of years, and we multiply it by a certain number of years of purchase. Now what this years of purchase means, it means that we expect the firm to make so much profit, that particular profit, that amount of average profits for the next 2 or 3 years. Okay, so that is number of years of purchase. So that is the average profits method. Again, there is a small deviation to the simple average method, which is the weighted average method. We use the weighted average method where the profits of the past years are showing an increasing or a decreasing trend. So where no trend emerges, then we use the simple average method. But where a trend emerges, then we use the weighted average, or we use the weighted average method by assigning the least weightage to the earliest year and the maximum weightage to the latest year. Right? The next method is a super profit method. Super profit means the excess profit that this particular firm for whom the goodwill is being valued makes vis-a-vis the other firms in the same industry. For example, if there is a firm which is carrying on the business of chartered accountancy, and it makes, let us say, 20,000 rupees per year as profits, while the other firms which are in the same business, they are all doing chartered accountancy business, they are making 15,000 rupees profits with the same capital employed, then this firm is better in the sense that it is making a super profit of 5,000 rupees. So essentially, super profit is nothing but the difference between the average profit and the normal profit that any other firm in the same industry makes, other conditions being the same. Okay, so then how do we value goodwill? Under super profit method, we multiply the super profit with the number of years of purchase. Okay, so here answer is B, number of years purchase into super profit. Next method is called the capitalization basis. Now what is this capitalization basis? Under capitalization method, we capitalize the super profit with the normal rate of return to get the goodwill. Okay, so answer is D, super profit divided with the expected rate of return. Next, profits of the last 5 years are lakh and 70, lakh and 80, lakh and 40, 2 lakhs and lakh and 60. Find the value of goodwill if it is calculated on average profits of last 5 years on the basis of 3 years purchase. Okay, so what we have to do here is we have to let's list out the profits year 1, 2, 3, 4, 5, lakh and 70, lakh and 80, lakh and 40, 2 lakhs, lakh and 60. Okay, so this data is given to us. So as we can see, there is no trend that emerges. It's neither an increasing trend nor a decreasing trend, and so we use the simple average method. And even in your exam, unless they specifically ask you to use the weighted average method, please use the simple average method. So let's find out the total of these numbers. 170 plus Okay, so this gives us 8 lakh 50, right? And so average profits is 8 lakh 50 divided by 5, which is lakh and 70,000 rupees, and goodwill is valued at 3 years purchase. We must not forget to multiply it by the number of years purchase. It's very clearly given to us in the problem. If nothing is given, then it is 1 year purchase multiplied by 1. So answer is 5 lakh 10,000 rupees. Okay, next. Profits and losses for the last 4 years are losses 20, losses 5, profit 196,000, profits 152,000. Average capital employed in the business is 4 lakhs. Rate of return expected from capital invested is 12%. Remuneration of partners is estimated to be 2,000 per month. The value of goodwill on the basis of 2 years purchase of super profits based on the average of last 4 years is. Okay, so here we are required to calculate the goodwill based on super profits method. So as I told you, super profit is nothing but average profit minus normal profit. Okay, is equal to average profit we have to calculate, but what is a normal profit? That is obvious. See, average capital employed in the business is 4 lakhs, and the return expected, it's not rate of interest, it's rate of return expected from the capital invested is 12%, which means the normal profit is 12% of 4 lakhs, okay, which is 48,000 rupees. Now we have to calculate the average profit. Average profit, now we might have a confusion whether to take the losses or not. Yes, we have to consider the losses. Let's take the last 4 years numbers given to us. It is 20,000, 5,000. Sorry, there's a profit. Profit of lakh and 96. Profit of lakh and 92. Okay, now let's make a total of this. It is 196 plus 192 minus 25, which is 3 lakh 63. Okay, total is 3 lakh 63,000 rupees, and the average is 3 lakh 63 divided by 4, 90,750. Average profits is 90,750, and we have to subtract the remuneration of partners at 2,000 per month, which is 24,000 rupees per annum, and so the average profit becomes 90,750 minus 24,000, which is 66,750. Okay, so average profit is 66,750. We have a normal profit, so this will give us our super profit of 18,750. Okay, we cannot stop here because it says that goodwill is 2 years purchase of super profits into 2. Okay, the 17,500. Okay, let's take a look at this problem. Okay, I think I made a mistake here. It is not lakh and 92, it is lakh and 52. Right? Okay, so it's undergo a change. It becomes 363 minus 40, 3 lakh 23. Okay, so 196 plus 152 minus 25. Yeah, so 3,23,000 is the total profits divided by 4. The average profit is 80,750. Becomes 80,750 minus 24,000, 56,750 minus 48,000, 8,750. So the super profit is 8,750. Okay, and the value of goodwill is 17,000 rupees. Right? So that is the answer. Answer is 17,500. Sorry, 17,500 rupees. 8,750 into 2 is 17,500. Right? Next. The same information is given to us, but they are asking us to calculate goodwill based on the annuity of the 4 years. Okay, so super profit, so this annuity method is a variation of the super profit method. So we calculated the super profit as 8,750 for the previous problem. It remains the same for this problem. Now we need to multiply it by the annuity factor for 4 years. 4 years where the discounting rate is 10%. Now how do we calculate the annuity factor? So the annuity factor for 4 years is nothing but the total of the present value factors of 1 rupee discounted at 10% per annum. Okay, so let us find out the present value factor of 10%, present value factor of rupee 1 discounted at 10% per annum. Okay, so the present value factor for the first year will be 1 by 1 plus 0.1. For the second year it will be 1 by 1 plus 0.1 the whole squared, 1 by 1 plus 0.1 the whole cubed, and for the fourth year it will be 1 by 1 plus 0.1 the whole raised to 4. So this is 1 by 1.1, 0.909. This will be 0.8264. This will be 0.7513, and for the last year the present value will be 0.6830. Now let's make a total of these PVFs to get the annuity factor. Okay, so it's 0.909 plus 0.8264 plus 0.7513 plus 0.683, which is equal to 3.1697. Okay, so goodwill based on the annuity method will be 8,750, which is a super profit, multiplied by 3.1697 into 8,750, 27,735. Okay, right, so there could be a rounding off error. Maybe they have not taken decimals up to 4 places. So the closest answer is 27,729, and so option is D. Right, next. Okay, this is an interesting problem. Okay, the profits for 2003-2004 are 4,000 rupees. 2004-2005 are rupees 52,500. 2005-2006 is 62,400 rupees. The closing stock for 2004-2005 and 2005-2006 include defective items of 4,400 rupees and 12,400 rupees respectively. Market value is nil. The value of goodwill on average profit method is, okay, so here we should not take the profits as it is given to us in the problem. We have to adjust for the error that has been made by the firm. Closing stock for 4, 5 and 5, 6 include defective items at the values given to us in the problem, though the market value is nil. We know that stock has to be valued at cost or net realizable value, whichever is lower. Now, what is the impact of having valued stock at 4,400 for FY 2005? When closing stock is overstated, profit is overstated, which means the profit that we have to consider for 2004-2005 is not 52,200, but it is 52,200 minus 4,400. Okay, next we come to 2005-2006. The profit given to us is 62,400, but this profit is vitiated because opening stock contains 4,400 and closing stock contains 12,400. So since opening stock is overstated, profit is understated, so we have to add back 4,400 to 62,400. Closing stock for 2005-2006 is overstated by 12,400, so we have to subtract 12,400 from 62,400 to arrive at the profits that have to be considered for valuing goodwill. Right? So now let's look at what are the profits that we have to consider. Okay, 2003-2004 no change, there are no errors, so we can take the profit that is given to us. 4,000 rupees is the profit. Next, 2004-2005 we have to take 52,200 minus 4,400. Okay, which is 47,800. Next, 2005-2006 we have to, the profit given to us is 62,400. We have to add back opening stock, which is overstated, to subtract closing stock, which is overstated. So we are going to subtract 8,000 rupees, so we will get 54,400 plus 47,800 plus 4,000 plus 54,400 is equal to 1,06,200. Average is divided by 3, 35,400, 35,400. Simple average, that's all. Okay, and so answer is B. Next, total capital employed in the firm is 16 lakh rupees. Reasonable rate of return is 15%. Profit for the year is 24 lakhs. The value of goodwill using capitalization method is. See, just look at the capital employed by the firm. It's only 16 lakhs, but the profit that the firm has made is 24 lakhs. So the rate of return is very high. So even before we make the calculation, we must understand that the value of goodwill is going to be very, very high for this firm. So let's see what the value of goodwill is. Okay, so here capital employed 16 lakhs, reasonable rate of return is 15%, right? So the profit that the firm has made is 24 lakhs. Reasonable rate of return is 15%. So if there is another firm which is making a return of 15% on its capital and the return for a particular year is 24 lakhs, then what is the normal capital that any firm would employ? It will be 24 lakhs divided by 15%, which is equal to 1 crore 60 lakhs. Okay, 1 crore 60 lakhs, any firm which wants to earn a return of 15% and in a particular year has made a profit of 24 lakhs, it means that the capital that it has employed is 1 crore 60 lakhs. But the firm that we are talking about has invested only 16 lakhs, but it is able to make so much profit. And so the goodwill that this firm enjoys is 1 crore 44 lakhs is the goodwill. With very less capital employed, it is able to earn very high profits. Okay, so answer is C. Next. X, Y and Z shared profits and losses in the ratio of 5:3:2. With effect from 1st January 2006, they decided to share profits and losses in the ratio of 2:5:3. The partnership deed provides that in the event of any change in profit sharing ratio, goodwill should be valued at 2 years' purchase of the average profits of the preceding 5 years. Profits and losses of the preceding 5 years are given to us. Okay, what is the single necessary journal entry that is involved? So here what is happening is there is a change in the relationship. The firm is not coming to an end, a new firm is not getting constituted. It's just that the relationship is changing. Earlier they were sharing profits and losses in the ratio of 5:3:2. Now they are going to change the profit sharing ratio to 2:3:5. So whenever there is a change in the profit sharing ratio, one or more partners sacrifice in favor of the other partners. So, and it is imperative or it is necessary to value goodwill whenever there is a change in profit sharing ratio. And how do we adjust for this goodwill? We know that goodwill cannot appear in the balance sheet as an asset. It is not permitted to show this goodwill in the balance sheet as an asset, and so the goodwill has to be adjusted through the partner's capital accounts. How is this done? We have to first of all find out who are the sacrificing partners and who are the gaining partners. Our second step is to value the goodwill. Our third step is to find out the gaining partner's share in the goodwill. Now this gaining partner has to compensate the sacrificing partners in the sacrificing ratio. That is what we have to do in this problem. So our first step, as I told you, is to find out who are the partners who are gaining and who are the partners who are losing. So the three partners are X, Y and Z. What is the old PSR? It is 5:3:2. So it is 5/10, 3/10, 2/10. What is the new PSR? It is 2:5:3. So 2/10, 5/10, 3/10. Now X is sacrificing, right? Because his old PSR is 5/10. Earlier he was getting 50% of the profits. Now he is getting only 20%. So he is sacrificing 3/10. X is sacrificing 3/10. Y is gaining 2/10 and Z is gaining 1/10. Okay, so this is our first step. Now we have found out who are the sacrificing partners and who are the gaining partners. Next, we have to value goodwill. 5 years profits are given to us: 39,000, 57,000, 24,000, 27,000, and there is a loss of 12,000. So let's find out the value of goodwill. 39 plus 57 plus 24 plus 27 minus 12. 135 is the total. So average will be 135 divided by 5, 27. Average profits are 27,000 and 2 years purchase into 2, 54,000 is the value of goodwill. Okay. Now what is the sacrificing partner's share in this goodwill? It is 3/10 of 54,000. Okay. So it is 5,400 into 3. 16,200 is the share of the sacrificing partner in the goodwill of the firm. Now this has to be made good by Y and Z in their sacrificing ratio to X. On their gaining ratio. Gaining ratio is 2:1. So 16,200 divided by 3 into 2 is Y's Y has to be debited with 10,800, he has to be debited with 5,400, and X has to be credited with 16,200. Okay, so entry is Y's capital account debit, Z's capital account debit to X's capital account. Answer is A. Next. A, B and C are partners sharing profits and losses in the ratio of 3:2:1. They decide to change their profit sharing ratio to 2:2:1. To give effect to this new profit sharing ratio, they decide to value the goodwill at rupees 60,000. Pass the necessary journal entry if goodwill is not appearing in the old balance sheet and should not appear in the new balance sheet. Okay, so very clearly options, we can rule out options B and C, because there is no question of goodwill. There is no goodwill in the balance sheet, so C definitely is not going to feature. B also, because we are not going to show goodwill in the balance sheet at all, and so we can straight away rule out B and C. So it could be either A or D, and to see this, we have to we have to um, first of all find out which partner is gaining and which partner is sacrificing. Okay, so A is to B is to C. The old PSR is 3/6, 2/6, 1/6. This is the old PSR. Okay, the new PSR is 2/5, 2/5, 1/5. Right, and now let's find out who is sacrificing and who is gaining. So let us see A, 3/6 minus 2/5. 30 is the LCM, so it's 15 minus 12. It is 3/30. So his old profit is greater than the new profit, which means A is sacrificing. Okay, now let's look at B. It is 2/6 minus 2/5. 30 again, so it will be 10 minus 12. So he is gaining 2/30. So B is gaining. And C, 1/6 minus 1/5. So it will be 5 minus 6/30, which is 1/30. So C is also gaining. Okay, so A is sacrificing and B and C are gaining. So 1/10 of 60,000. 3/30 is 1/10. So A's share of goodwill is 10,000 rupees. Sorry, 6,000 rupees. And this 6,000 rupees has to be made good by B and C in the gaining ratio of 2:1. So it's 4,000, 2,000. And so the journal entry is B's capital account debit, C's capital account debit to A's capital account, amounts being 4,000, 2,000 and 6,000. So answer is A. Next, come to problem number 29. A person may be admitted as a new partner in accordance with a contract between the existing partners or with the consent of all the existing partners. In accordance with a contract between the existing partners or with the consent of all the existing partners, subject to the provisions of section 30 of the Act. Okay, so answer is B, because C, after obtaining specific approval of the registrar of firms and societies, is not relevant. By simply taking consent of the new partner only is not the right answer. So answer is B. Subject to the provisions of section 30 of the Act and subject to the consent of all the existing partners, a new partner is taken into the firm. Which of the following is true? Okay, so now we are looking at problems relating to admission of a partner. So whenever a partner is admitted, he is expected to bring his share of capital, okay, and he is expected to bring his share of goodwill. It is not necessary that he has to bring it in cash. He can bring his share of capital and his share of goodwill in any form other than cash also. Okay, he can bring it in the form of furniture, or he can bring it in the form of motor car. It can be a contribution. It can be in any other asset, the form of any other asset. It need not be the form of cash only. Understand? So when a partner is admitted into the benefits of a firm, he has to bring two things. He has to bring in his share of capital, and he has to bring in his share of goodwill. Okay, and whenever he is not able to bring in, unless he brings in capital, he is not going to get admitted into the benefits of the firm. Okay, but sometimes what happens is he is sometimes not able to bring in his share of goodwill as cash. See, we know that whenever a partner is admitted, whenever there is a reconstitution in the partnership, okay, when a new partner is admitted, there is going to be a change in the profit sharing ratio, right? So when there is a necessity to value goodwill when a new partner is admitted into the firm, and the incoming partner is supposed to bring in his share of goodwill as cash, but sometimes he is not able to bring his share of goodwill as cash. Then what do we do? Then in that case, the incoming partner has to compensate the sacrificing partners for his share of goodwill in the sacrificing ratio. Understand? So the next thing the next thing that we have to keep in mind is that whenever there is an admission of a partner, revaluation of assets and liabilities takes place. Again, it is not just as it is imperative to value goodwill at the time of admission of a partner. The partners might choose to revalue the assets and liabilities, they might not choose to revalue the assets and liabilities. So, where the partners choose to revalue the assets and liabilities, then when the balance sheet is prepared after admitting the new partner, the assets and liabilities will appear at the revalued amounts. Where the assets and liabilities are chosen not to be revalued, then they will continue to appear at the old book values. Understand? Okay. So then the next adjustment that we have to keep in mind is the existing reserves have to be distributed amongst the old partners in the old profit sharing ratio. If there are any accumulated losses in the balance sheet, those have to be distributed amongst the old partners in the old profit sharing ratio. And whenever there is a revaluation, the revaluation profit or loss belongs to the old partners, and it has to be distributed amongst old partners in the old PSR. Okay, so these are what we have to keep in mind whenever there is an admission of a new partner. Okay, so problem number 30: which of the following is true? An incoming partner acquires his share from all the old partners in their profit sharing ratio. Not necessary. An incoming partner, not all the existing partners have to sacrifice. A few might sacrifice, a few need not sacrifice. Okay, an incoming partner acquires his share from all the old partners in some agreed ratio. An incoming partner acquires his share from one or more of the old partners in some agreed ratio. So answer is C. So it's not necessary that he has to acquire his share from all the partners. He can acquire it from one or more partners in some agreed ratio. So answer is C. Next, unless otherwise agreed, it is presumed that sacrificing ratio is the same as the old PSR. New PSR of the old partners is the same as the old PSR. Or new profit sharing ratio of the old partners is equal. Both A and B, right? So answer is D, both A and B. See, it's like this. Let us say uh, that there are two partners, A and B, who are carrying on business, sharing profits and losses in the ratio of 3:2. Okay, and C is admitted for a 1/5 share in the profits. Understand? And nothing else is given. They are not telling us how C is going to acquire this share of profits. How much A is going to sacrifice, how much B is going to sacrifice, we do not know. So in such a situation, the sacrificing ratio, that which means that this 1/5 share that C is going to get will be given to him in the ratio of 3:2, and The new profit sharing ratio obviously will, between the old partners, the relative profit sharing ratio between the old partners will continue to remain 3:2. Okay, so answer is D, A and B. Okay, in case revaluation account is not prepared, assets and liabilities appear in the books of reconstituted firm at their old book values. So only when there is a revaluation of assets and liabilities that happens, only in that case the assets and liabilities, the values will be changed, and they will appear at the market values or the revalued figures in the balance sheet of the reconstituted firm. Next, revaluation account is debited, right? So now we must remember that this revaluation account is a nominal account, which means that all losses have to be debited, all profits or any favorable change that happens in the assets and liabilities has to be credited. Sorry, which means that suppose there is an increase in the value of an asset, then you have to credit the revaluation account. Entry will be asset account debit to revaluation account. Let us say land is appearing in the books at 1 lakh. You are going to revalue it to 3 lakh 50. Okay, which means you are going to write up the value of land by 2,50,000 rupees. So you have to debit land with 2,50,000 rupees and credit revaluation account with 2,50,000 rupees. Okay, so this is and suppose there is a decrease in the value of a liability, it is something that's favorable to the firm, that will be credited to the revaluation account. Where assets are written down, you have to debit it to the revaluation account. Where liabilities have to be increased, it will get debited to the revaluation account. So keeping this in mind, revaluation account is debited whenever there is an increase in provision for doubtful debts. Correct. Whenever there is an increase in provision for doubtful debts, revaluation account will be debited because it is a loss. Okay, there is going to be an increase in the loss, and so it is the revaluation account will be debited. So we don't even have to go through the other options. It's obvious that the answer is A. Next, partner's capital account is debited. Okay, to record profit on revaluation. See, profit on revaluation will be credited to the partner's capital accounts. When we open the revaluation account, profit on revaluation will be appearing on the debit side of the revaluation account, because the credit side will be heavier than the debit side, and so the profit on revaluation will be appearing on the debit side, and the revaluation account will be closed by transferring this profit to the partner's capital accounts, and hence we have to credit partner's capital accounts with the profit on revaluation. Similarly, general reserve. How do we close general reserve? General reserve as a credit balance. So when we close something that has a credit balance, we have to debit it. So general reserve account debit to partners capital accounts. Record P&L account debit balance. Here we will be debiting partners capital accounts because P&L account is having a debit balance, and when we close something that has a debit balance, we have to credit it. And what are we going to debit? We are going to transfer this loss to the partners capital accounts, and so capital accounts have to be debited, right? To record the shortage of capital brought in, capital is being brought in, so entry will be bank account debit to partners capital account. So here we'll be crediting partners capital account. So answer is C. Next, A, B and C are partners sharing profits in the ratio of 3:2:1. D is admitted. The new profit sharing ratio amongst A, B, C and D is 3:3:2:2. The gain or sacrifice will be, okay, so let us, A is to B is to C. Okay, A is to B is to C. Old ratio is 3 by, okay, let's make it more spacious. A, B, C. Okay, 3/6, 2/6, 1/6. This is the old PSR. Now, what is the new PSR? D is getting admitted, and the new PSR is 3/10, 3 by 10, 2 by 10, 2 by 10. Okay. Now we have to see who is sacrificing and who is gaining. So 3 by 6 minus 3 by 10. LCM is 60, so 30 minus 18. 12 by 60. Then 2 by 6 minus 3 by 10. 60. So this is 10, 20 minus 18, which is 2 by 60. So 1 by 6 minus 2 by 10. 60. 10 minus 12. So C is actually gaining 2 by 60. Okay, so the sacrificing, which means here A is sacrificing 12 by 60. In other words, he is sacrificing 6 by 30 of his share. B is sacrificing 1 by 30 of his share. C is gaining 2 by 30. D is gaining 2 by 10. So here A sacrifices 6 by 30, B sacrifices 1 by 30 is the correct answer. B is not the correct answer. C gained 1 by 30, D gained 2 by 10. That is also the correct answer. So answer is both A and C. Okay, next. A and B are partners sharing profits and losses in the ratio of 7:3. Okay, A and B, A and B, and a new partner is C. Okay, the old PSR is 7 by 10 and 3 by 10. Okay, A surrenders 1/7 of his share. So what is the sacrifice by A? It is 1 by 7 of 7 by 10. So sacrifice by A is 1 by 10. What is B's sacrifice? It is 1 by 3 of 3 by 10. So B is also sacrificing 1 by 10, which means C is going to get 1 by 10 plus 1 by 10, which is 2 by 10. Okay. Now what is a new PSR? New PSR for A will be 6 by 10, 2 by 10, 2 by 10. So 3:1 is the new PSR, and the sacrificing ratio is 1:1. So answer is D. Okay, next. 37. Okay, you have A, B and C who are sharing profits in the ratio of 3:2:1. So it is A's old share is 3 by 6, B's old share is 2 by 6, 1 by 6. Right? W is admitted with 1/6 share. W is getting, this is the old PSR, and W is admitted for 1 by 6. Okay. It says C would retain his original share. So the new PSR for C is going to be the same. W is going to be the same. Right? Which means C and W together are going to take up 2 by 6 of the profits, which is 1 by 3rd. Which means 2 by 3rd of the profits are available to A and B, which they will be sharing in their in the ratio of 3:2. Okay, so 3:2, this is the relative profit sharing ratio of A and B, and they're going to share the remaining profit of 2 by 3 in this ratio. So it is 3 by 7 into 2 by 3, and B's new profit sharing will be 3 by 5 into 2 by 3 and 2 by 5 into 2 by 3. So this will be 6 by 15 and this is 4 by 15. So the new PSR is for A is 6 by 15, B is 4 by 15, C is 1 by 6 and W is 1 by 6. Right? Now the common denominator for all this is 30. So let's multiply this by 2. So we get 12 is to 8 is to 5 is to 5. So this is the new profit sharing ratio. 12 is to 8 is to 5 is to 5. Next. Okay. A and B are two partners sharing profits and losses in the ratio of 3 is to 2. Right. So you have A, B, C is admitted. Old PSR is 3 by 5, 2 by 5. Admitted C. Okay. A gives 1/3 of his share. So A's sacrifice is 1 by 3 of 3 by 5, which is 1 by 5. How much is B sacrificing? He is giving 1/10 from his share. So directly 1 by 10 he is giving. Which means C's share is going to be 2 by 10, which is nothing but 1 by 5 plus 1 by 10. So C is admitted for a 3/10 share in the profits. So now what is going to be the new profit sharing ratio? It will be 3 by 5 minus 1 by 5, which is 2 by 5. This is 4 by 10 minus 1 by 10, which is 3 by 10, 3 by 10. This can otherwise be written as 4 by 10, 3 by 10, 3 by 10. So the new PSR is 4 is to 3 is to 3. Okay, so answer is D. Next. A and B are partners sharing profits in the ratio of 3 is to 2. C is admitted. A and B will in future get 2/6 and 3/6 share in the profits. What is the share of C? So 2/6 plus 3/6 is 5 by 6, which means the remaining is 1 by 6. So the equivalent fraction of 1 by 6 is 5 by 30. So answer is C. Okay. Next. A and B are partners sharing profits in the ratio of 1 is to 2. They admit C for 1/5 share and they decide to share future profits equally. The new profit sharing ratio will be. So by looking at the options we can find out that the answer is A 2 is to 2 is to 1 because C is admitted for 1/5 share and A and B amongst themselves they want to share equally, so 2 is to 2 relatively they are sharing equally, and so answer is A 2 is to 2 is to 1. Next question. A and B are partners sharing profits and losses in the ratio of 5 is to 3. C is admitted. It is decided that the profit sharing ratio amongst A, B and C will be 25 is to 15 is to 9. What is the sacrificing ratio? Okay. So if we have A, B, C, the old PSR is given to us as 3 is to 5 is to 3, sorry. So it's 5 by 8 and 3 by 8. C is admitted and the new PSR is going to be 25 is to 15 is to 9. So 25 by 49, 15 by 49 and 9 by 49. Okay. Now what is the sacrificing ratio? Sacrificing ratio will be 5 by 8 minus 3 by 8 minus 15 by 49. Five is to, okay. See here, instead of going through this process, the most intelligent way of tackling this problem is, see, we know that LCM is going to be a big challenge here. So we must understand that obviously there is some shortcut that we have to use in order to solve this problem. What is it? See, if you look at the old profit sharing ratio of A and B, it is 5:3. Okay, if you look at the new relative profit sharing ratio of A and B, that is also 5:3. If the old profit sharing ratio and the new relative profit sharing ratio are the same, it means that the sacrificing ratio is also the same as the old profit sharing ratio. And so answer is A, 5:3. Okay, next. A and B are partners sharing profits and losses in the ratio of 5:3. They admitted C and agreed to give him 3/10 share of the profits. The new profit sharing ratio after C's admission will be. Okay. Right. So here A, B, C. The old PSR is 5/8, 3/8. Okay, and they are admitting C for 3/10 share, which means that A and B amongst themselves have to take 7/10. Understand? So in what ratio will they take it? They will take it in the ratio of 5:3. So it will be 5/8 into 7/10, 3/8 into 7/10. So this is 35/80, this is 21/80, this is 24/80. So the new PSR is 35:21:24. So answer is B. Next. A and B are partners sharing profits and losses in the ratio of 5:3. They admitted C and agreed to give him 3/10 share of the profits. C is acquiring 1/5 share from A and 1/10 from B. What is the new PSR? The sacrificing ratio is given to us. We have to find out the new PSR. Okay, we have A, B, C, 5:3, 5/8, 3/8, and C is admitted for 3/10 share. He is getting 2/10 from A, 1/10 from B. So this will be 5/8 minus 2/10, 3/8 minus 1/10. Okay, LCM is 40, 25 minus 8, 15 minus 4, 12/40. Okay, so this will be 17:11:12. The new PSR is 17:11:12. Next. A and B are partners sharing profits and losses in the ratio of 5:3. On admission, C brings rupees 1,40,000 cash and 96,000 against goodwill. The new PSR is 7:5:4. Find the sacrificing ratio of A and B. Okay, so here you have A, B. Old ratio is 5/8, 3/8. C is admitted, after which it becomes 7/16, 5/16, and 4/16. This can otherwise be written as 10/16. This can be written as 6/16. Okay, so sacrificing ratio will be 3:1. Old ratio minus new ratio, 10/16 minus 7/16 is 3/16, and 6/16 minus 5/16 is 1/16. So 3:1. Okay, next we come to the 45th question. A, B and C were equal partners of a firm with goodwill of rupees 1,20,000 shown in the balance sheet, and they agreed to take D as an equal partner on the terms that he should bring 3,20,000 as capital and goodwill. His share of goodwill was evaluated as rupees 1,20,000. and the goodwill account is to be written off before admission. What will be the treatment for goodwill? Okay, so there is existing goodwill in the balance sheet of lakh and 20,000 which has to be written off. Secondly, his share of goodwill, the incoming partner's share of goodwill has to be distributed amongst the old partners in their sacrificing ratio. So answer is both A and B. Next, P and Q are partners of a firm sharing profits in the ratio of 2:1. R is admitted to the partnership with effect from 1st April on the terms that he will bring 40,000 as his capital and 1 by 4th share as his capital for 1 by 4th share, and he pays 18,000 rupees for goodwill, half of which is to be withdrawn by P and Q. How much cash can P and Q withdraw from the firm, if any? Okay, so here R is bringing in rupees 18,000 for his share of goodwill, half of which can be withdrawn. So half of 18,000 is 9,000. So the amount is clear. A total of 9,000 rupees can be withdrawn by P and Q. And in what ratio? It has to be in the sacrificing ratio. So here the sacrificing ratio is the same as the old profit sharing ratio of 2:1. And so they can withdraw 9,000, the ratio of 2:1, which is 6,000 and 3,000. Next, A and B are partners of a firm sharing profits in the ratio of 3:2. They take C as the new partner who is supposed to bring rupees 50,000 against capital and rupees 20,000 against goodwill. New profit sharing ratio is 1:1:1. C brought cash for his share of capital and agreed to compensate to A and B outside the firm. How will this be treated in the books of the firm? Okay, so here he is supposed to bring 50,000 as capital and 20,000 against goodwill. Okay, and what does C do? He brings in his share of capital, but for the share of goodwill he says he is going to compensate A and B outside the firm. So no entry will be passed for this compensation of C with respect to goodwill to A and B outside the firm. Only the entry for C having brought in capital into the business as cash will be entered in the books of the firm as cash account debit to C's capital. So entry answer is A. Next we come to 48. A and B are partners of a firm sharing profits in the ratio of 3:2. They take C as the new partner who brings in rupees 50,000 against capital and rupees 20,000 against goodwill. New profit sharing ratio is 1:1:1. In what ratio will this amount be shared by the old partners A and B? Okay, so here C's share of goodwill, 20,000 rupees, has to be shared by the old partners in their sacrificing ratio. Now what is the sacrificing ratio? We have to calculate. A, B, C. Old ratio is 3/5, 2/5. New ratio is 1/3, 1/3, 1/3. So sacrificing ratio is 3/5 minus 1/3 and 2/5 minus 1/3. So this is 4/15, 1/15. Sacrificing ratio is 4:1. Right. So 4:1 means this 20,000 rupees goodwill has to be made good to A and B in the ratio of 4:1. So 4/5 of 20,000 is 16,000 and 4,000 to B. So the entry will be C's capital account debit to A's capital to B's capital. 20,000, 16,000 and 4,000. Right? So answer is A. Next. A, B and C are equal partners. D is admitted to the firm for 1/4 share. D brings rupees 40,000 as capital and 10,000 being half of the premium for goodwill. What is the value of goodwill of the firm? So here D is bringing in half of whatever he has to bring as goodwill. So half of whatever he has to bring is 10,000, which means D's share of goodwill is 20,000. D is admitted for 1/4 share. So for 1/4 share, if he has to bring in 20,000, then the value of the goodwill of the firm is 80,000 rupees. Next, A and B share profits and losses equally. They admit C as an equal partner and goodwill was valued at rupees 60,000. C is to bring in 40,000 as his capital and the necessary cash towards his share of goodwill. Goodwill account will not remain in the books. What will be the final effect of goodwill in the partner's capital accounts? Okay, so C's share of goodwill, the value of goodwill of the firm is 60,000 rupees. Okay, goodwill of the firm is equal to rupees 60,000. C's share in the firm is 1/3, which means C's share of goodwill is rupees 20,000. And C has to make good this 20,000 to the sacrificing partners in the sacrificing ratio. So old ratio is 1:1, new ratio is 1:1:1, which means sacrificing ratio is also 1:1. So this 20,000 has to be made good to A and B equally. Okay, so the entry will be C's capital account debit 20,000 to A's capital account to B's capital account. Okay, next. X and Y are partners of a firm sharing profits in the ratio of 2:1. They take Z as a partner and the new profit sharing ratio is 3:2:1. Z brings in 9,000 rupees as premium for goodwill. What is the full value of goodwill? So Z is getting admitted for 1/6 share, and for 1/6 share he is bringing in 9,000 rupees, which means the value of goodwill of the firm is 9,000 into 6/1, which is 54,000. Next, A and B are partners with capitals of rupees 20,000 and rupees 40,000 respectively. They share profits equally. C is admitted as a third partner with 1/4 share in the profits of the firm on the payment of rupees 24,000. What is the amount of hidden goodwill? Okay, so now how to calculate hidden goodwill? Okay, first of all, what we have to do is we have to find out the value of the firm. Value of the firm is nothing but the amount that the incoming partner brings in multiplied by the reciprocal of his share. So the value of the firm is 96,000 less capital of A is 20,000, capital of B is 40,000, and what has C brought in? C has brought in 24,000. So 84,000 is what is the total of the capitals of A, B and C, and so this 12,000 rupees is the hidden goodwill. Next, A and B are partners with capitals of rupees 30,000 and rupees 20,000 respectively. C is admitted as a third partner with 1/6 share in the profits of the firm. The amount of C's share in the capital of the firm, if he is asked to bring in capital in proportion to his profit sharing ratio, will be how much? Okay. So here the total capital of A and B is 50,000 rupees. Okay, and C is admitted for 1/6 share, which means this 50,000 is capital for 5/6 share, and so the full value of the capital of the firm will be 50,000 into 6 by 5, which is 60,000 rupees. So the capital that C should bring in order to make his capital in proportion to the profit sharing ratio will be 1 by 6 of 60,000, which is 10,000 rupees. So now, after C's admission, A's capital is 30,000, B's capital is 20,000, and C's capital is 10,000. 3:2:1 will be the profit sharing ratio. Okay. Next, X and Y are partners of a firm sharing profits and losses in the ratio 4:3. Z was admitted for 1/3 share in the profits of the firm. On the date of Z's admission, the balance sheet of X and Y showed a balance of 4,200 in P&L account on the asset side of the balance sheet and a general reserve of 42,000. What is the final effect on X's capital account? Okay. So the existing P&L account debit balance has to be written off amongst X and Y in the ratio of 4:3. So Y's share of this loss will be 4 by 7 of 4,200, which is rupees 2,400. Right? Next, this general reserve which is there in the balance sheet has to be distributed to X and Y in the ratio of 4:3. General reserve is 42,000, so X's share is 4 by 7 of 42,000, which is 24,000. So this is a debit to X's account, this is a credit, which means the net credit is going to be 21,600 rupees. This is the net credit to X's account. Answer is A. Next, A and B are partners sharing profits and losses in the ratio of 3:2. The capitals of A and B remaining after adjustments are 48,000 and 36,000 respectively. They take C as a partner who contributes 21,000 as capital for 1/5 share of profits to be acquired equally from both A and B. The capital accounts of old partners are to be adjusted on the basis of the proportion of C's capital to his share in the business. Calculate the amount of actual cash to be paid off or brought in by A. Okay, so here they want to make the capitals in line with the or they want to adjust the capital on the basis of C's capital. Okay, so here C is admitted for 1/5 share, for which he brings 21,000 rupees as capital. Okay, and so the full capital is 21,000 into 5, which is 1,05,000 rupees. Right, so here the full value of the firm's capital is 1,05,000 rupees. Our next step will be to calculate what is the new profit sharing ratio. A is to B, the old profit sharing ratio is 3 by 5, 2 by 5. C is admitted for 1/5 share, which he takes equally from A and B, which means he is taking 1 by 10th from A and 1 by 10 from B. This 3 by 5 can be written as 6 by 10. This can be written as 4 by 10, which means the new profit sharing ratio is 5 is to 3 is to 2. Okay, so 5 is to 3 is to 2 is the new profit sharing ratio, and the new capital has to be in this ratio, which means A's new capital should be 5 by 10 of lakh and 5,000 rupees, which is 52,500 rupees. But the existing capital of A is 48,000, and so A has to bring in 4,500 rupees cash in order to make his capital in line with the new profit sharing ratio. Next, A, B and C are partners in a firm sharing profits and losses in the ratio 3 is to 2 is to 1. D is admitted into the firm with 1/4 share in the profits, which he gets 1/8 from A and 1/8 from B. D is to bring in cash equivalent to 1/4 of total capital, 1/4 of total capital of new firm. The capitals of other partners are also to be adjusted in the ratio of their respective share in profit and loss. The respective capitals of A, B and C after all adjustments have been worked out at 20,000, 15,000 and 19,000 respectively. Calculate the final capitals of A, B and C. Okay, so here A, B and C, 3 by 6, 2 by 6, 1 by 6 is the old profit sharing ratio. D is admitted for a 1/4 share, which he is taking 1/8 from A and 1/8 from B, which means C is not sacrificing, right? So the new PSR is going to be 3 by 6 minus 1 by 8, 2 by 6 minus 1 by 8. This is going to be 1 by 6. This is 1 by 4. Okay, so here 24, 12 minus 3, 24, 8 minus 3. This will be 4 by 24, 6 by 24. Okay, so the new profit sharing ratio is 9 by 24, 5 by 24. So the new profit sharing ratio is 9 is to 5 is to 4 is to 6. Okay, and C is bringing in, D is to bring in cash equivalent to 1/4 of the total capital of the new firm. Okay, so the total capital of A, B and C after all adjustments is 20,000, 15,000, 19,000. Okay, this comes to 54,000. So 54,000 is for 3/4 share, therefore the full value will be 72,000. Okay, and so D will have to bring 1/4 of this, which is 18,000. D has to bring in 1/4 of this, which is 18,000. And now we have to find out what is going to be the new capitals of the existing partners. So A has to bring 9 by 24 of 72,000, which is 27,000. A's capital should be 27,000. B's capital should be 5 by 24 of 72,000, which is 15,000. And C's capital is 4 by 24 of 72, which is 12,000. Okay, so the revised capital balances of A, B and C is 27,000, 15,000 and 12,000. Next, X and Y are partners of a firm sharing profits in the ratio 5:3. Z was admitted on the following terms. Z would pay rupees 1 lakh as capital and rupees 32,000 as goodwill for 1/5 share in the profits. Machinery would be appreciated by 10%. Book value is lakh and 60,000 rupees. Building would be depreciated by 20%. Book value is rupees 4 lakhs. Unrecorded debtors of rupees 2,500 would be brought into the books, and a creditor amounting to 5,500 died and need not pay anything to his estate. Find the distribution of profit or loss on revaluation between X, Y and Z. See, first of all, Z does not be entitled to any revaluation profit or loss, because the revaluation profit or loss solely belongs to the old partners and it will be distributed to them in the old profit sharing ratio. Next step is to find out what is the revaluation profit or loss. Okay. Now, with respect to machinery, there is a profit. 16,000 is the profit. Okay. Next, with respect to building, there is a depreciation of 80,000. So this is a loss. Next, unrecorded debtors. You are bringing an asset into books, so it is a profit. Next, creditor amounting to 5,500 died. You don't need to pay anything. It is a profit. Okay, so here the 24,000, 80,000 minus 24,000 is 56,000 loss, right? And it has to be distributed in the ratio of 5:3. So 5 by 8 of 56,000 is 35,000, and the remaining 21,000 will go to the other partner. This is for A, this is for B. This is how the loss is going to be distributed. Next, balance sheet prepared after the new partnership agreement. Assets and liabilities will be recorded as the revalued figures. Next, X and Y are partners of a firm sharing profits in the ratio of 5:3 with capital of 5 lakhs and 4 lakhs respectively. Z was admitted on the following terms. Z would pay 1 lakh as capital, 32,000 as goodwill for 1/5 share in the profits. The balances of capital accounts after admission of Z will be what? Okay, so here Z is admitted and he brings in 32,000 for 1/5 share. So let's find out. The sacrificing ratio is going to be 5:3, which means the existing partners' capital accounts. First of all, the existing balances. What are the existing balances? Existing balances are 5 lakhs, 4 lakhs. Okay. Now Z is bringing in lakh and 32,000 rupees, so there is going to be a credit first to his account of lakh and 32,000 rupees. Next, Z has to compensate X and Y for his share of goodwill in the sacrificing ratio. So this 32,000 rupees will be credited to X and Y in the ratio of 5:3. Correct? So it's 20,000 and 12,000. 20,000, 12,000, and there is a debit of 32. So the revised balances are 5 lakh 20, 4 lakh 12, 1 lakh. So these are the closing capital balances of the three partners, right? Okay, so with this we come to the end of this session on partnership accounts part 1, right? And we will continue with retirement and death in our next session. In case you have doubts, you may feel free to mail me, and so until next time, goodbye.